afternoon, and thank you all for joining this third session in this substantive series of webinars sessions being hosted by the EU-Canada Chamber of Commerce. It's my pleasure today to be with you all. My name is Céline Bach. I'm an associated partner with Carney, and I'm delighted to introduce the four panelists for this session today. Marie-Aimée Bourry, who's the head of impact-based finance at Société Générale. Thank you for joining us, Marie-Aimée. Pablo Pérez Montero, who's a senior director and head of sustainable finance at CaixaBank. Thank you for joining us, Pablo. Catherine Preston, vice president of sustainable investing at OMAR. Welcome and thank you, Catherine. And Susan Thompson, director, sustainable finance and corporate transitions at TD Securities. Thank you very much for joining us, Susan. We're going to kick off this short and pithy session with a very brief presentation to give us all some background on the sustainable finance regulatory, I guess, differences and similarities and the opportunities between Canada and the EU. Just to start off, and we're all aware, obviously, that ESG investing has become a substantial endeavor, and investors are becoming increasingly scrupulous about these. Investor appetite is making ESG a major growth area. Mandatory disclosures and standards are increasingly rigorous and providing greater reliability. Shareholder activism is increasing with the and making this area of even greater salience. We know, for example, that in 2021, almost 650 billion US dollars entered ESG funds worldwide. This was a substantial increase, and there are a number of other indicators that we have here that really suggest that this is now a mainstream part of business. Most of us are engaged, and many of us are aware about the fact that governments are increasingly requiring disclosures of climate-related risks, and we have the SEC, the Canadian Securities Administration, the EU Commission, the UK Treasury, all as examples of these. And we have sorry, there we are. Let's go back one. Thank you very much. And ESG issues will continue to dominate the proxy season this year, with already there being a significant number of these being successful in the first 8 months of 2021. I'll briefly touch on in the next slide the regulatory instruments that are currently in place, and really focus on the goals, because this is where there's terrific alignment between the EU, Canada, and you know, obviously the alignment via the CETA. The instruments are different, I should say, and I'll start with those. The EU taxonomy, the Sustainable Finance Disclosure Regulation, the Corporate Sustainability Reporting Directive are the instruments in the EU. In Canada, they are the Net Zero Accountability Act, the GHG Pollution Pricing Act, the OFSI and CSA disclosures requirements, and the proposed Climate Aligned Finance Act, which would and could provide an increase in the alignment between Canada and EU standards. The goals, however, as I mentioned earlier, are quite aligned in terms of increasing investment. In the case of the EU, the goal is $1 trillion in investment, with as a goal a 55% reduction in emissions by 2030. With a 40% target of renewables by 2030 as well. Canada's goal is slightly lower, in the 40 to 50% range by 2030. It has a substantive carbon price goal of $170 per ton by 2030 and $100 billion in investment targeted, with both jurisdictions being committed to net zero by 2050 and a commitment to innovation and clean growth. I'll briefly touch on the specifics in the next slide of the EU regulation, which has three major parts. The first being the requirement or the definition of economic activity being either making substantial contribution to one of 6 environmental objectives, eventually also to doing no harm to any of the 5 environmental objectives, and then eventually meeting minimum social safeguards as outlined by the UN and the OECD. The EU taxonomy rests on the Corporate Sustainability Reporting Directive, which requires large corporations to disclose the percentage of their revenue, operating expenses, and capital investment that is taxonomy aligned, and the Sustainable Finance Disclosure Regulation, which requires institutional investors and banks to disclose the percentage of their portfolios that are taxonomy aligned. And this, of course, is moving through in terms of its implementation. From January of this year, there was mandatory corporate reporting for Objective 1 for revenue, OPEX and CAPEX. In January of next year, there will be mandatory reporting on alignment for all parties, including corporations and investors, for all of the objectives above. If we go to the next slide, I'll briefly touch on the Canadian regulatory situation. We have the Office of Superintendent of Financial Institutions will require disclosures aligned with the TCFD beginning in 2024, and the Canadian Securities Administration have announced 2 proposed instruments on climate risk and ESG disclosures. The Net Zero Accountability Act enshrines a commitment to achieve net zero emissions by 2050, and under this law, Canada published a comprehensive emissions reduction plan in March of this year, which outlines how the 40% reduction will be achieved by 2030. The pillars of the Pan-Canadian framework, as I mentioned earlier, include carbon pricing, clean tech innovation, funds for adaptation, new standards and codes, as well as regular reporting on progress, and I mentioned earlier, the rising carbon price. There is a proposed Climate Aligned Finance Act, which was introduced by Senator Galvez in March this year, which would align Canada's financial system with its climate commitments by creating a new public duty for directors, reducing conflicts of interest and other factors as well. And so finally, this slide summarizes the opportunities and the potential for the CETA to allow Canada and the EU to cooperate on regulatory standards. So we have in place the Canada-EU Regulatory Cooperation Forum, which provides a channel for communication of EU and Canadian regulators to cooperate bilaterally on policy issues of mutual interests, and that can include sustainability disclosures. There is also the agreement between the Standards Council of Canada and the European Committee for Standardization, which was reviewed and renewed in 2019, and it provides a clear opportunity to improve the harmonization of Canadian and EU sustainable finance standards. And then finally, the Canada and EU regulators can build on the momentum created during the December 2020 meeting of the CETA Committee on Trade and Sustainable Development, which outlined areas for collaboration in regards to sustainable finance. And so in a very short sort of round of the houses, that is the current situation in terms of the regulation between Canada and the EU. It's a pleasure now to open what I know is going to be a very interesting and substantive discussion. And I'm going to start with a question to Pablo to tell us about CaixaBank and the history that it has in regards to sustainable finance and its net zero balance sheet commitment.
Hello, everyone. Thank you very much, Celine, for the introduction. And first of all, I would like to say thank you to the organization EU-Canada Business Day. It is a great pleasure and honor for me and for CaixaBank to be part of this event 1 year again, and to share with all of you and with this extremely good panelist this space. For CaixaBank, it is a very special and important thing because it's one of our main pillars in our strategy for the next years. CaixaBank is one of the financial institutions most committed to the sustainability. Through different kind of initiatives, the bank is supporting environmentally friendly initiatives and projects that contribute to the preventing and mitigating climate change and to encourage social development and the transition to a low carbon economy. In 2021, the year that we're recently closed, the bank mobilized 31 billion euros in sustainable financing. That figure represents an increase of 150% comparing with the previous year, 2020. And CaixaBank ranked as the 6th bank in Europe in green and sustainable loans in the top league tables by volume and according to Refinitiv and Bloomberg. It is a very important milestone for us because that confirmed that we are supporting and promoted this activity globally, but especially in Europe because of our footprint, it is really focused on this geography. Since the 2015 Paris Agreement, a long list of regulatory milestones and push for sustainability have emerged and focus on the first need to decarbonize globally and every level. This transition to a carbon-free economy poses an ambitious and complex challenge. Our bank, as a financial institution that operates in 24 countries, with our main focus in Europe, but extremely increasing our positioning in the American continent, mostly North America, accepts its role and conduit of financing to promote investment to help our customers for the transition to a carbon neutrality. CaixaBank is founding member of the Net Zero Banking Alliance, a commitment by the banking sector to achieve the zero net emissions by 2050, in the line with the 1.5 degrees target, and to establish in the coming months a decarbonization target of the most polluting portfolio for 2030, aligned with the Paris Agreement and the momentum which was fundamental in the recent COP26. It follows the recommendation of the Task Force on Climate-Related Financial Disclosure, normally known as TCFD, to boost measures taken in response to climate-related financial risk and quality of climate information. This alliance, the Net Zero Banking Alliance, it is one of the most important objectives that we are involved and that we are to promote in the next year. For us, as a financial institution, it is extremely important, the Scope 3. It is something that we measure and that we are defining a new strategy in order to draw the line to decarbonize our balance sheet completely until 2050. This is something that are going to be a big challenge for every sector, and it implies really important investments and really important changes in every sector, beginning by transport and continuing by industry, infrastructures, energy, retail, or others. And that's our positioning, that's our focus, and that's our ambition. And it is something that we would like to share with all of our clients and all the regulators and all the stakeholders in the market in order to bring from them support to be part of this alliance.
Very ambitious position to take. And thank you very much for the description in such substantial terms. Before I turn to Catherine and with a question for OMARS and the work that OMARS is doing, I wonder if you could speak briefly about how the EU regulations have informed your strategy.
Okay. Continuing with this question, CaixaBank has always perceive regulatory changes as an opportunity to anticipate to legal requirements and to try to show its best practice and compliance regarding the new regulatory developments. Focusing on the evolution of the sustainable finance, and after the Paris Agreement that we mentioned before, the European Commission published a European strategy in 2016 on sustainable financing. Subsequent, the central banks and the regulatory bodies have confirmed climate risk and systemic risk that has to be embedded to the internal policies to mitigate climate change and to redirect the capital flows towards the sustainable investments. All the following years until 2021, all the regulation that was under development entered into force, and now the European Union countries and companies have the obligation to comply with the European laws that help integrate climate and environment risk into their management and governance and social impact. Our bank strategy has always been very proactive, and we established all the internal steering committee to study the market and our peers, and designed an internal project with an external advisor to improve all the legal requirements across the level project involving many areas. In these areas, we belong to this process and to this committee from the business side, supporting the strategy, legal and compliance areas of the bank. Since 2018, CaixaBank has been member of the UNEFI, which partnership between the United Nations Environment Programme in 2018 and the global financial sector to mobilize private sector funding to sustainable development. Next year, 2019, it joined to the collective commitment to climate action, CCCA, which drives the commitment that all the signatories of the principles for responsible banking have made to align their business strategy with the Paris Agreement temperature goals. Due to all these efforts, the integration of sustainability into the bank business model and decision-making processes are among the factors that contribute to CaixaBank improvement on the international ratings. For example, in addition to obtain the CDP's best score for the 10th consecutive years, CaixaBank remains on the Dow Jones Sustainability Index at one of the world's most sustainable banks in the top 10, and has been ranked Spain's best bank in the ranking of environmental, social and governance risk by the analyst Sustainalytics. And that's, I hope to give you a quick overview about our regulation strategy and priorities. And please let me know if you need any other detail about it.
Well, thank you very much, Pablo. That's really helpful to understand how it's been I guess it's been a constant process really since 2016, and really fundamentally integrated in the governance of CaixaBank's operations. Catherine, I'm really looking forward to hearing from you, and your perspective from the buy side. What is OMAR's overall investment approach, and what kinds of assets that you are engaged in considering and investing in, and then how that may have something to do with working with European partners.
Absolutely. Thanks, Selena. And thank you to the EU Chamber for the invitation to be with you during this event today. So maybe I'll start with a bit of a background on OMARS. We may be a new organization to many of you in attendance. So OMARS stands for the Ontario Municipal Employees Retirement System. So we're a defined benefit pension plan serving more than 540,000 members here in Ontario. And our members include people employed by municipalities and could be in roles as police officers, librarians, or children aid society workers. And on behalf of those members, we invest more than 120 billion Canadian dollars. The balance sheet of the investment portfolio is approximately half in public markets, half in private assets, and that private asset side is split almost evenly between real estate, infrastructure, and private equity investments. We're a global investor, so the diversification across geographies looks like more than 44% in the US, 30% on our home shores here in Canada, and then 16% in the EU and UK, as well as a 10% allocation to the Asia Pacific region. These investments are really, it's an active investment strategy focused on direct drive, and that more than 90% are managed directly by our colleagues, so not through funds as much. So it's a very direct investment approach, Celine.
Very interesting. And can you perhaps tell us a bit about your investments in the EU, in EU assets, and the parties with whom you are making those investments, and how the EU investment environment is informing and I guess enabling OMARs to build up investment skills and strategies, given the difference in that investment setting.
So we have investment teams on the ground in the region and tend to do private investments across Europe. So really in the infrastructure space, it could be anything from ports to renewable energy assets. And we'll partner with various different types of actors, so other global pension plans, some EU-based, some Canadian. It really runs the spectrum. That happens globally as well. So although OMARS itself is a Canadian organization, because we have offices directly in Europe, we may not be bound by the SFDR you described, but our partners are. And so when we partner in investments or make co-investments together, we do follow similar approaches to kind of measuring and reporting. And they ask us questions about our own sustainable investing activities as they do their due diligence on us before investing with OMARS as partners. So we may not be obliged to those regulations as a Canadian entity, but we do it by course of business based on the expectation of our partners. And then as we think about exiting or selling out of assets in that region, of course, we have to be up to the level of expectation of the market from that regulatory perspective and the market perspective.
That's very interesting. And can you describe, maybe through an example, I'm not sure, what that means in terms of your 2030 commitments and your investment portfolio. Obviously, those are substantial goals that you're trying to achieve, while at the same time ensuring defined benefits for your 440,000 members.
Yeah, so you're referring to the carbon intensity reduction goals we've set. We've set both a long-term goal, net zero in the portfolio by 2050, as well as a shorter-term goal, which is a 20% reduction in carbon intensity across all the assets in the portfolio by 2025. So our executive team wanted to make sure that their teams were accountable today for really taking on the understanding and management of climate risk across the portfolio, recognizing this changing climate is posing risks and opportunities across assets and geographies. And then we want to make sure that we're managing that and reducing it over time in line with the net zero 2050 pathway. And so what does that mean for us as an institutional investor? We have a couple of levers for carbon reduction. One is working with our existing portfolio companies and their carbon footprint and their plans to decarbonize in line with the Paris Agreement. And the other is what we invest in. So we have a couple focus areas, one on engaging, whether it's with our direct private asset portfolio, where we have more material interest, so greater financial exposure, as well as more control and often board seats. The engagement with those companies is happening very directly. And then on the public side, where our engagement is more collaborative or through our proxy voting tool that we have at our disposal to, again, communicate our expectations on decarbonization pathway over time. And this is something we're continuing to monitor and explore as standards, tools, taxonomies get better defined to help us do that.
Very, very interesting. Well, I think that we'll circle back, but just the breadth and depth of tools that are coming forward and that are going to be made available to us, obviously, as a result of your engagement, as well as the proxy voting tools at your disposal. I mean, obviously, they will increase the quality of disclosures over time, which of course will enable greater progress. So Susan, I'm going to turn to you and ask about how you're accompanying through buy-side investment companies with examples from specific sectors and what TD is accomplishing and what your intentions are as well.
Yeah, absolutely. And good morning, good afternoon, everyone. And thank you for having me here today. So my team, it's a Sustainable Finance and Corporate Transitions team. It was formed in November 2020 as part of TD's Climate Action Plan. So our team is a dedicated ESG resource within the dealer, and we act as a center of expertise to provide our clients with advisory services on everything that has an ESG overlay. So ESG reporting frameworks, ESG ratings, ESG regulations, and taxonomies. And we also provide advice and expertise on structuring sustainable debt products and help our clients bring these transactions to market. So we really need to understand our clients' transition plans and to support that transition financially. So, so you pointed out in your introduction that we've seen some phenomenal growth in the sustainable finance market as companies look to fund their transition. So 2021, we saw over 1.6 trillion of volumes. So that's more than 2020 volumes, more than double 2020 volumes across GSS bonds, loans, and sustainability-linked bonds and loans. So in the sustainability-linked products in particular saw tremendous growth. So it's the fastest growing product segment within the capital markets today. And that covers both the loans and the bond side. And the interest rates, as you may be familiar with, are tied to the achievement of sustainability performance targets. So unlike the use of proceeds instruments, sustainability-linked debt, they can be used for general corporate purposes, and they provide a flexible alternative for many borrowers to access the sustainable financial markets, most especially companies in the hard-to-abate industries. So the SLB allow new sectors to access sustainable investors and funding opportunities. So high-emitting sectors that are crucial to the successful economy-wide transition are far more prominent in the SLB market than in the use of proceeds markets. And given their forward-looking key performance indicators, all the SLBs are arguably inherently about transition, whether it's climate, broader green, or social transition. So for decarbonization transition specifically, they represent a very good opportunity for companies' net zero targets to be linked up with access to the financial markets. So for example, just to put this all in perspective, Canadian energy company Enbridge, they issued $1 billion, I believe at the time it was a 7 or 8 year bond, linking their financing to board diversity and greenhouse gas emissions reduction targets. So they were able to do this through that sustainability linked market. They wanted to show their commitment to their sustainability targets, and they're able to achieve their financing and put the two together. So for another example, mining giant Newmont, they issued a sustainability linked bond. They were the first mining industry company to issue an SLB, and they also aligned it to their goal of emissions reduction as well as women in senior leadership positions. So again, someone in the more hard to abate area was able to support their transition and access the financial markets at the same time. So I think all of this to say that the means to achieve goals is evolving, and our clients, the governments, corporations, they're all focused on their decarbonization and achieving their net zero commitments. And we're here to play our role and help them achieve their goals.
Very interesting. And, is one of the areas that we touched upon in our preparatory meeting was the whole area of energy efficiency. That's I guess a triple bottom line sort of opportunity, right? It obviously enables companies to decarbonize, but at the same time to generate savings and perhaps even to lower their cost of capital, as you've just described, the sustainability and and other diversity-linked bonds. Would you like to comment on that area as an area where you're developing tools to help your clients?
Yeah, of course. And I think banks really do play a large role in helping our clients and supporting their transition and their decarbonization pathways, right? As I said, we need to understand our clients' transition pathways and their plans in order to support them. And then we can support that transition financially. So we help our clients, we advise them. We advise them on different pathways, conducting peer benchmarking analysis, and we really work closely with them to ensure their targets are material and ambitious. And I think just getting back to your question of renewable energy here, we see that a lot, right? It coming up in KPIs, sort of key performance indicators on both the loan side and the bond side. And it's either selected as a standalone, because clearly it's the most prominent. Everyone seems to be focused on renewable energy, greenhouse gas emissions targets. And we also see it included as part of company selection of either an absolute scope 1 and 2, or even just a reduction of greenhouse gas emissions KPI. So it is very prominent here. And I think as we continue to evolve, and the market is quickly evolving, as I'm sure we are all aware here, that scope 1 emissions targets, it used to be the minimum, like the baseline that the market looked for to be material and ambitious. And again, that's changing very rapidly. Now it's almost like the scope 1 and scope 2 are the table stakes. We saw with the SEC, they're proposing scope 3 disclosures. So before long, we could be seeing all 3 of those. And like I said, as the bank, one of our roles is to advise clients, and it's also trying to keep clients up to date on the latest and greatest that's happening in the ESG space.
Mm-hmm. Yeah, so I mean, this gets back to the systemic importance, right, of disclosures, because scope 3 emissions reductions are going to mean a much more active role from key OEMs, primes, who are going to try to raise the quality of the disclosures of their supply chain, right? Which may be an area where financial institutions can play an important role. Thank you very much, Susan, and I'm really looking forward to hearing more about how TD continues to expand its the portfolio of the innovation behind the offerings that it's bringing to the market. Marie-Aimée, I think we have a terrific opportunity in having you here with us to really understand what are the foundations of Société Générale's work, in its impact-backed financing area. You head that work up for the whole of Société Générale. This is a very significant and large purview. Please tell us about what has taken you to this point, and what your priorities are going forward.
Yes, sure. So I think similarly to my colleagues who've already spoken before, the bank is also, Société Générale has been for long involved and a pioneer in sustainable finance. We've always been one of the founding members of the collective initiatives like the Principles for Responsible Banking, Net Zero Banking Alliance, etc. And I think it's important because it's in these collective cooperative initiatives with peers and also industry players that we can learn and help bring convergence on the standards and the metrics used in order to be more efficient throughout the whole continuum of the investing community. So of course we do, and I'm not going to list all the awards and the things we do. I think we clearly are. We have been for more than 150 years a bank for the real economy. So very active in project finance, asset finance, financing SMEs in France, in Africa, in Eastern Europe, etc. And that's great. And of course, as the market of sustainable finance has developed, as was very well, presented by Susan, of course, we embarked as well on this to help our clients be able to structure credible, financing, whether it's for green or social use of proceeds instruments or for sustainability linked, where credibility is very important in the KPIs you're choosing. because there is a risk of backlash and ESG or SDG washing linked to those transactions. So we are very careful, and we often refuse mandates or opportunities because we do not think the company has done enough work in determining a truly committed and credible strategy of decarbonization. But what happened about 3 years ago is we realized that even if we do this as much as we can, this is just going to be continuing to finance the business as usual. So yes, accompanying our clients in their transition, but what are we doing for the funding gap, the 2.6 trillion yearly funding gap, which we, I think, wrongly call a funding gap, because in fact it's an investment gap. We all know there are about approximately 100 trillion of assets under management in the world. So there's no shortage of institutions like OMAR or else who are very keen to invest into sound and profitable and sustainable assets. But the issue is to tackle all the challenges that the SDGs are representing. There is a very stubborn 2.5 trillion a year that needs to be invested, and that is not. And that's why we've decided to create a team that focuses specifically on that. So where are all those investments? Well, they are primarily in developing countries. 90% of that gap is in developing countries, and half of it, 1.3 trillion, is in Africa. And what type of investment are we talking about? We're talking about addressing the needs of the bottom of the pyramid. So access to power, access to water, access to connectivity, education, healthcare, etc. Which currently we have the technology to provide those services and goods, but the business models have not yet been adapted. And so we need to help our clients improve their business models, so reduce the costs, look for local partnerships, and combine the solutions, so have what we call an impact-based approach, which is looking at when addressing a specific need in a specific country for a specific community, looking at how to bundle other products and services so as to reduce the cost to impact, improve the resilience of the project by addressing more services. So what we've been doing concretely, so it's a bit of what you would see as an impact fund, if it's not, we are not in an asset management function. So it's really the bank looking with project finance, asset finance, financing vehicles to finance projects that address these needs of access to electricity in rural areas in Africa, for example, access to connectivity, and also in developed countries, energy efficiency, because there is a lot to do in developing countries. But when we look at one of the easiest thing to do in order to reduce our carbon footprint, sobriety, and improving the energy efficiency of all our buildings and processes, increasing the use of circular economy business models, this is something that is not enough invested in, and often it's because the business models are different. We're not anymore financing, an equipment or capex. We are financing clients who are providing product as a service or energy as a service, providing, energy efficiency performance contracts. And this is different type of contracts that the banks are less used to finance. So our team is focused on supporting our business lines to adapt our business models, and if we can put those financing on our balance sheet, of course, we are trying to push internally to do that, and otherwise to structure them and channel them to investors, impact investors, or institutional investors like pension funds or insurance companies that are looking for this type of impact investments.
Oh, that's so much richness in what you've just described. But I'm very curious. I mean, do you foresee a day where we will see securitization of the kinds of loans that you're describing? so that they are, I guess, part of a more liquid capital market?
Well, the end game is to make those business models become mainstream. Like, for example, currently we're focusing on how to finance off-grid mini-grids to provide access to energy in remote areas in Africa. And, when talking to practitioners that have been doing business in Africa for a long time, what they tell us is that these assets are today what the telecom towers were 10 or 15 years ago. Nobody thinks it's bankable, it's never going to happen, and yet it happened. And now financing, telecoms in Africa is a business that has become, relatively mainstream. So really, the idea is to go first, find the different blended finance structures that will allow us to finance those assets and create the market. Because all of these investments, they represent, again, hundreds of billions of dollars investments in the next decade. And we need to help our clients make their business models affordable and profitable for them so that these markets are addressed, because they are absolutely key in achieving the Paris Agreement, but also when considering the other challenges such as water scarcity, such as investing in nature, promoting nature-positive business models, and all the different principles that are related to the circular economy, which are also very important, but quite new and requiring a bit of R&D and support.
Absolutely. As we find ways of making circularity business models work, obviously there's a lot to be done there. I'm very tempted to ask you about the scenario which is the basis of the $2.5 trillion annual funding, investment gap. I think it's the IEA 1.5 degree net zero scenario. There are other scenarios that are used for that as well, but the benefit of those is that they give us that North Star, right, so that we can use to then establish the opportunity, as you spoke about, the $1.3 trillion opportunity annually in Africa and in emerging markets. We have just a few minutes. This has been so very, very interesting. All of you working in ways which are very innovative and establishing new benchmarks, new frontiers. I guess I can maybe just offer each of you a few minutes or a few seconds actually for you to perhaps comment about the opportunity for collaboration between the EU and Canada. And we'll wrap up on that note, if that's okay with each of you. Maybe I'll start with you, Susan, if you can perhaps comment on what you see as the place where we can work together.
Yeah, I think what you touched on briefly earlier, disclosure, I think that's going to be huge going forward. And I think here in Canada, we're a little bit behind where Europe is in terms of ESG. And I think we can really look towards Europe to give us, sort of just watch where they're going, watch what they're doing, and then learn from them as well. And sort of bounce ideas off each other, see what works, see what doesn't, and try to really streamline this disclosure. And I think investors would really appreciate that as well. As there's so much to learn, and there's so much out there, and disclosure will be important. So I think in that respect, and any ways we can share would be very helpful going forward.
Thanks, Susan. And Pablo, what about you? Where do you think Canada and the EU can work together? And then Catherine and Marie-Aimée, I'll ask you. Pablo, do you have a place where Canada and the EU could work together?
Yeah, sorry, I was trying to,
no worries,
to check the silence. Talking about the opportunities to CaixaBank in Canada, it is something important and a reality for us that the American continent is one of our main opportunities for the next year, and concretely the United States and Canada as two of our main opportunities to achieve. Since the Canada-European Union Comprehensive Economic and Trade Agreement, the CETA, was approved and the Spanish government ratified in 2017, CaixaBank moved quickly to help its customers to take advantage of new opportunities in Canada. Our main focus, or in terms of footprint, is Europe, but we try always to support our clients at many places in the world or wherever they go. And talking about the big European corporates, Canada, it is one of the main geographies for them. Trade relations between Spain and Canada have become more dynamic than ever, and making Canada an increasingly important trading partner for Spain and for Europe. From this perspective of the European policies that promote sustainable finance have also an impact on Canada, which is receipt of new rules and requirements that the Europeans are demanding and expanding for their partners on a global level. And we believe that the integration of globalization, sustainable financing will become a tool increasingly used in all geographies to promote by all governments and countries. I don't know if you want to talk about the hydrogen or maybe before and after, sorry.
I think we may be running out of time, so I'm going to pass the baton to Catherine. Thank you very much, Pablo. That's very interesting.
Yeah, I'll try to speak very quickly. I think, Susan nailed it. We often look to the EU, who's been much more advanced on sustainable finance and building out the taxonomies. But I do think there's areas to work together as we think about this transition sleeve. You know, Canada as a resource-based economy, we're thinking a lot about the role our natural resource companies will play in the transition, in delivering secure energy to our trading partners around the world. And so how does that fit within the net zero? How do we work with those companies and kind of think about disclosure and taxonomies around transition, companies as a transition towards net zero?
Interesting, thank you. Marie-Aimée, the final word is to you before we close off with Delphine.
Yeah, well, I'd say blended finance, because I've seen that, you know, there is really a very strong culture of both from the government entities, foundations, and you know, different platforms like the Convergence platform, which have already a very strong practice of blended finance, which is absolutely essential if we want to support the investments in least developed countries and developing countries. So I'm sure that Canada can teach a lot to Europe on this, and then cooperation in that matter could be very useful.
Very interesting. Impact investing in developing countries through blended finance. Thank you very much.